Hey everyone, it's Michael Valtos from Orderflows, and welcome to the Orderflows market analysis for Tuesday, June 20, 2017. And it was another quiet day on the economic news front, and another day with heavy selling in oil. We got down below 43 bucks. I think we closed around 43.35. We're down about 75 cents in the crude. Inflation looks very weak right now. Oil prices, the declines in oil prices are starting to get more attention by the Fed. And stocks, which rallied yesterday on Monday, nice big rally, they gave back some of it today on Tuesday, and the market fell back. Dow was down about 0.3%. That said, there was a few trading opportunities. Monday there was a lot of nice opportunities. Tuesday there was a few, but I said it was kind of a quiet day overall. But I'll show you the ones that really stood out the most with the order flow. Before we jump in, the brief disclaimer: this presentation is for educational and informational purposes only, should not be considered a solicitation to buy or sell a futures contract or make any other type of investment decision. Futures trading contains substantial risk and is not for every investor. An investor could potentially lose all or more than the initial investment. Risk capital is money that could be lost without jeopardizing one's financial security or lifestyle. Only risk capital should be used for trading, and only those with sufficient risk capital should consider trading. Past performance is not necessarily indicative of future results. Tools I use in this presentation are the Orderflows Trader, which is the volume footprint chart, and I talk about the Delta Scalper in many markets. I show you some great examples of how the Delta Scalper picks areas in the market where, based on the order flow, the market is changing from a supply-driven market to a demand-driven market. What that means is a market that's been selling off turns and starts to rally, or a demand-driven market, a market that's rallying, gives a sign that it's moving from a demand-driven market to a supply-driven market. So basically not picking a top, but alerting you to a potential top in the market. Again, I don't, even though I talk a lot about turning points, it's really the market telling me that the market is turning. It's not me trying to predict, oh, there's a turning point here. No, rather, I'm just reading what's happening in the market, and the market is just naturally telling me that, hey, there's a turning point here, a potential shift in supply and demand. So, we'll start in the 5 years. 5 years was interesting because, going back to, this morning, 5 o'clock, 4 o'clock, you had your high, you had your ratio, you got a divergence. And again, I always say, whenever you get a high and you have a divergence and you got a ratio in the order flow, that's a great opportunity to take that trade. And so here at our high, we sold off from our high down to your low. You got a ratio, no divergence, just the ratio. We rally back up to a new high with the divergence. But what else do you see in here? You see Delta Scalper giving a sell at this high, Delta Scalper next bar off the low giving a buy, Delta Scalper giving a sell up here. So you're selling off from your high down to your low. You got a buy signal, you got a sell signal on your high, a buy signal just off the low, another sell signal just off the high. You do start rallying back up later. 950, you had the Delta Scalper again, give us a sell signal. You have a ratio, no divergence, but the sign in the next bar is this bullish ratio. So again, if you're short off this, the next bar is telling you, hey, you might want to think seriously about getting out of this position. So again, that's what the order flow does. It tells you, not only does it tell you when when to take trades, but can tell you when to get out of trades, based on what's happening in the market. Why should you let the market go all the way up to your stop price to take you out? If you could read what's happening in the order flow, get out. Now, this one bar here at 926, where you have this 9 lots here, I was very keen on seeing what was going to happen when we trade back into this area, this thin spot, so to speak. And I wanted to see us fill it. I treat these as gaps, and we did. We came back in. Now I was really looking for this bar to turn red and trade lower. Instead, you just got one tick through, you filled the gap, and you continued rallying. I really, I felt that if we could stay below this area, I think we could trade at least down to 6, 5.5. But anyway, we didn't. We filled the gap, and as in normal gap analysis, you close the gap and you continue up in your direction. Nothing really later in the order flow to get too excited about. But really, the big things were early. Just 5 with the ratio with the divergence, you hit the low, start rallying up, you get another Delta Scalper buy, another Delta Scalper sell. I mean, it's literally just bouncing off highs and lows. Okay, so just staying on the interest rates for a while. This is the bonds, and again, you got a few interesting things here. 5 in the morning, 5:30, you got a ratio with a divergence. You got a nice 8-tick sell-off where you rally back up, and you got another ratio with divergence. And unfortunately, it doesn't sell off. It just comes back up here, stops you out. You got Delta Scalper giving a sell. This one didn't work out, and it came right back up here. New highs, and another Delta Scalper, but it's a Delta Scalper on a green bar. So I'm not looking to get short on a green bar. It's a Delta Scalper sell here on a green bar. You need the bar to continue down, be red. You don't want to be getting short on a bar that can't even close lower than it opened when you're looking to get short. If the market's rallying, why are you getting short there? But the thing that I want to point out is, going back since 743, even though earlier you had the divergence here, and 2 hours later you came back up and took out the divergence, but in more recent history you got 743 failed divergence, 759 failed divergence, 950 you got a divergence, and when I start seeing 3 or 4, 3 usually failed divergences, I'm looking for the fourth. And what I'm going to be looking for is, when we start coming back up to the high, I'm going to be looking for some aggressive buying to come in. And here you're coming up, you hit the high. You got, a buying imbalance, another buying imbalance just next to it. So, I know that when I start seeing failed divergences in, sort of grouped together on a chart, that chances are if we're going to test those highs, we can still go higher. And so this was a nice place to get long. I said, now I'm not big necessarily on buying breakouts. However, on trending markets, if you could buy a breakout, you're going to be rewarded nicely. And, any sort of sign that the market's trending will help you. And to me, failed divergences are a sign that the market's, it's got some trending underway. And you come up, see, this is a nice 6 ticks right here, 5 ticks, 6 ticks. I mean, if you could just take 5 ticks out of the bonds every day on a one lot, that's some decent money. You could do that with, if you can just make 10 ticks in the bonds a day at the end of, every trading day of the year, that's $70,000 or more or less at the end of the year. Now, I'm not saying that everyone could do it, but again, if think in that terms. I mean, you don't have to make $5,000 on every trade. If you can squeeze, if you could grind out your profits consistently, that's what's going to keep you in the game longer. It's not the big home runs. Yeah, it's always nice to hit a home run on a trade, but being consistent is more important. So you rally up from this 08 to 09 area all the way up to 15. You got another ratio with divergence to sell off another 6 ticks. You start rallying back up. You hit the high again, and then you close for the day. Okay, so the next market I'll talk about are beans, soybeans, ZS. And again, soybeans is not as glamorous as trading crude or as glamorous as trading E-minis, but beans are a great contract for trading. Out of a lot of these agricultural contracts are actually very nice for trading, and they do follow order flow quite nicely. So 8:30 is the reopen after the evening session. It goes into a halt stage and reopens at 8:30. 8:35 you've got this red arrow here. You got the trap traders and coming up right in here, and we rally. We sell off into new lows. You got down here, you have point of control on this green bar right at the bottom. You got a bullish ratio. There's some supportive buying coming in here, right? To me, this bar is very bullish. What happens? Selling comes right back in the next bar. You can see the imbalances. So, even if you're getting long here, you get stopped out. It's not the end of the world, right? Bad trades happen. You do get stopped out on trades. Fortunately, you could have caught this previous bar here, a nice move down. Covered it here, look to get long, take the loss. Then we come down into this low here. We got, at this level here at 928, there was some decent volume, 967, 756, even 300. You got about 2,000 contracts, supporting this market. So, we got through that, and market's looking for its low. It hits its low down here at 926. Another sizable bid down here. 210 lots traded. You got a zero print. You got point of control right at the bottom. So it's kind of similar to this other bar here that failed. However, the big difference is you got the positive delta. So you got a divergence. And I see, you got a blue number. It's a ratio. It's 0. And what happens is the market rallies, right? You got a ratio with a divergence. Market rallies. I always say buy those ratios with divergence. This one is just a ratio, no divergence. This one is a ratio with divergence. And it goes up from the 927 area all the way up to the 930, starts coming back down, hits back down to 6.5, doesn't test that low, and we just go sideways, start rallying. I'll say rallying, but we get back all the way up to 931. Delta scalper gave a sell. Then you get down here, right at 928.5. Point of control at the bottom. You got a bullish ratio. Next bar, delta scalper. And over the next two bars, you shoot up about almost 2 cents before selling back down into this area where I know there's support coming in down here, and then you just sort of go sideways into the close. The other market I'll talk about really quick is the euro currency. There was something interesting in the euro currency this morning, and let me just find the chart here that I could pull the chart in and talk about it. It's right here. Time was this? About 9:30 in the morning ish, I think. And again, it's about understanding order flow. Understanding what you're seeing in the market. Now, okay, you got delta scalper giving a sell here, but it's a green bar. Okay, and again, shouldn't be looking to take shorts on green bars, right? If the bar was red, that's when you should be looking to take the short, not on a green bar. But anyway, why what's happening here is actually it's not delta scalper, this is delta surge. I'm sorry, but still, again, you shouldn't be looking to take the trade on a green candle. You should be taking it on a red. It's a delta surge, so it's telling me negative delta is building up. But what's happening is the market's rallying. Green candle, green candle. Now people have written to me quite nasty emails actually, and say, oh, this delta surge that you're giving out sucks. Look, I put it on my chart, and it told me to sell here, and I sold it, and the market rallied. I got stopped out. I lost money. Well, you're not understanding. First of all, you're not understanding order flow and how to use the indicator. And, and secondly, like I say, you always say, if you're looking to get short, the market's got to confirm it, right? Rather than just an indicator saying, hey, get short here, and oh, no, okay, I'll get short here. I hate to use the term, if your friends are jumping off a bridge, do you jump off too? No. You sit there and you analyze what's going on and sit here and look at what's going on. You got negative delta, negative delta. And why? Because you have supportive buying coming in. You got 117, 116, 129, 112 here on this people coming in and bidding the market. People are selling it. Yeah, people are selling into this, looking to go lower, but there's still just more passive buying coming into the market. More people supporting this market. That's why you have the negative delta. Just because you have negative delta doesn't necessarily mean the market's selling off. When you have negative delta on a green bar, it's telling you there's supportive buying coming in, just like you have it over here. 252, 341, 170. You see the market popped up a little bit, and then it's coming back in almost around these same levels. At 91, 90. These areas. Even in the next bar, stronger negative delta, minus 199. But look, you got supportive buying here, 129, 93, 93, 90, 83. What do you got trading on the offer side? You got squat, one bar, 100 and one level, 108. Everything else, 40, 22, 39, 71, 12. But there's more selling going on. There's more selling into the bid than buying from the offer. That's why you have the negative delta. You have negative delta because someone sells into the bid, that's -1. Someone buys from the offer, that's +1. So even though you have negative delta based on supportive buying coming in, and it's helping to move this market up. So watch that stuff when it happens around lows, okay? Because it's important, or the opposite around highs. And what happens? So again, delta surge, yeah, it gave a signal. It's just reading the delta. That's what the delta surge does. It doesn't take all this other stuff into account, the way the delta scalper does. But it's just reading the delta by itself. But what it's got negative delta on green bars should be alerting you to something. Professional traders take the information that's put in front of them, and sometimes what's happens in the market that's opposite of what the information is telling them is just as important as what the information is doing, what the information tells you to do, right? Information tells you to buy, you buy, market goes up, yeah, that's right. But information tells you to sell, and the market keeps going up. Well, wait, stop and think, what's going on? Why isn't that market selling off? Everything says to sell off, yet the market's rallying. So there's some underlying force in that market, and this is a good example. Like I said, traders that that are not good, but people that aren't consistent in their trading, that they're not able to put these little pieces together and understand that what doesn't happen is just as important as what does happen sometimes, if not more important. And then what happens? We get back up here, we make the swing high, and then you got some nice passive offers coming in here: 284, 296, 265, 176. This is volume that people are up here. Yeah, we get back up to 99, 112 even. People are happy to sell up here. Hey, I'm a seller. They're putting their hands out. People are buying it, but they can't move it any higher because there's strong sellers up here. Market starts coming down. Then you get back down to this area where you had the supportive buying earlier, right? From 89 basically to up here to 92.5. I mean, you could see the volume sticking out on all these, on all these bars here. But then what happens? You get past that volume. Where's the buyers? They're gone, right? The buyers are gone now. And what happens? Boom, you got a big stack selling imbalance there. Market goes lower. So when you have supportive buying, right, and it's exhausted, who's there left to support the market? It's not there anymore. So market sells off. Now what do you got? You're trading, 5 ticks lower, and maybe some of these people that were buying it been here, supporting that market, coming in here thinking, hey, there's support. I also want to support the market. Now maybe they're turning sellers and hitting this bid on the way down. So it's about understanding what's happening in the market rather than just taking an indicator that says buy or sell. That's what order flow does. That's the difference. You ask yourself, what kind of trader do you want to be? Do you just want to be someone that's just going to sit there and follow, oh, this line turned blue, it's time to buy, or this line turned red, it's time to sell? No. Good traders think, the best trading algorithm is the one that's on, in your brain. It's not the one that's, someone programmed. It's in your brain. I think now more than ever is actually, a good time for traders that, actually think in the market, because, all these algos are chasing after the same alpha, after the same thing, looking at the same thing, and then, they can't put sometimes all these different pieces together at once. I mean, maybe someday Jeff Bezos will come up with some super trading algo for Amazon and release it. But, for now, I think, the amount of traders that actually sit there and make trading decisions using their head is, there's an article, I think it was like at 10% now in the market. Everything else is so computerized. But again, just because, something's computerized doesn't mean it's great. Hell, sometimes you call it, you call the airline and you get this touch tone system. Oh, please enter your ID number, your frequent flyer number. You say it, and then it repeats back something completely different. Is this correct? No. Oh, okay. You're in, and it's just every answer you give it just reads it as something completely different. It's so frustrating. So, for if you think computers, are the greatest thing, for trading, think again. All of these hedge funds, I'll say algo hedge funds, I'll say all of them, but a good portion have been closing down over the last several years. Why? One is they're all chasing after the same thing. These little slices of profit that keep getting smaller and smaller and smaller. That these funds, they can't stay in business. They can't meet their payrolls. I know guys that work for these algo-based hedge funds. They get laid off because they're making profits barely, but more importantly, they can't meet payroll. And it's that doesn't get reported in the papers. Just hedge funds are suffering their biggest loss as those people pull their money out. Yeah, people are pulling the money out because index, the S&P's up 10%, and a lot of these hedge funds are luckily breaking even. People are saying, what the fuck am I giving my money to some guy to take 2% off the top and profits when I can just put it in a freaking mutual fund and get better returns? That's why hedge funds are suffering. But something that doesn't get reported are a lot of these algorithmic hedge funds that are closing shop. They're just closing up. Anyway, that's my rant on that side of the business. I've got a lot of rants lately, but let me just see if I could pull in one other market, if I could find the chart really quick. Japanese yen. Yeah, we'll talk about yen today. or yesterday. So, going back to 8 o'clock. Let's go back here. So, here you did have a divergence, but no ratio in the bar. Next bar is green, and then you got a bearish ratio here, but it's one bar removed. I would like this bar to be right here. So anyway, we came off a bit here. Delta Scalper gave a buy. It did pop up here, but it's it came down, took the low of this bar out by 2 ticks, rallied back up. Delta Scalper gave another sell here. You do got a nice ratio up there, followed by a stacked imbalance here, followed by some trap traders in the next bar, and this was a nice move down here. You got sort of a lot of things going off at once. You got ratio, you got single print, Delta Scalper, stacked imbalance, trap traders, and you go down from the 90 even area down into the below 89.90. You do rally back up. You get up here. What time is this? This is 11:09 again. It's kind of similar. You got a ratio, zero print, Delta Scalper, stacked imbalance, and it comes back here. Now the difference from this one here, you got the bearish trap traders here, you got the bullish trap traders. The market did pop up before selling off. And then you come down here, you got stacked imbalance, right? And I always say, when you get stacked imbalance, look for the next bar for help you give you confirmation. And what do you got in the next bar is you got the opposite confirmation. You've got a bullish ratio. If you get a bearish ratio after a bar with an imbalance, stacked imbalance, to me it's all systems go. Turn off the lights, put the trade on, turn off the lights, go take a piss, come back, and hopefully it's in your favor. But still, read the order flow. What's happening? You've got a bearish sign followed by a bullish sign. Do you want to stay in the trade? Probably not. And then the next bar, even Delta Scalper, and the market pops up here before going into the close. Okay, so thanks for watching this. I'll keep it short today. Said it was kind of a quiet day today. A bit tired. So thanks for watching this. If you want to learn more about order flow, visit my website, orderflows.com. Subscribe to my YouTube channel. I've got 150 videos. I didn't realize I got so many already. And and so you'll be notified when I got a new video comes out. So again, visit www.orderflows.com and subscribe to my channel below. Thanks everyone. Bye bye.